All right, let's jump right into it. Today, we're tackling a question that's absolutely key for anyone in business. What happens when you make a sale, but you don't get the cash right away? It's a super common situation, so let's break it down, get it right. So, picture this. You've just sold a product. You did the work, the customer has their item, they're happy, but when you look at your bank account, nothing's changed. So, how on earth do you account for that? Where does that money you've earned actually go in your books? That's the big puzzle we're going to solve. Okay, let's dive in. Before we even think about numbers, we need to get the main idea down. And this first concept, well, it's the foundation for everything else we're going to talk about. And here it is. It's called a credit sale. It's still a sale, 100%. You've earned the income. The only difference, and this is the key, is the timing. The customer gets the goods now, and you get paid, well, later. The deal is done. The cash is just taking the scenic route. So what do we call this customer who owes us money? In the world on accounting, they get a special name. Let's meet this new character in our accounting story. They're called a debtor. Yeah, it sounds a little formal, maybe a little intimidating, but really, it's just the official term for any customer who's promised to pay you later. So every time you make a credit sale, poof, you've just created a debtor. Okay, now this is where it gets really interesting. A cash sale? Simple. Money comes in, your bank account goes up. Easy. But a credit sale? That's a different story. Since there's no cash yet, we can't touch the bank account. Instead, we open up this special account called Debtor's Control. Think of it as a waiting room for all the money that's owed to your business. So how do we actually get this down in our records? Well, like I said, every credit sale is basically a two-part story. Let's start with part one, booking the fantastic income you just made. We're going to keep this super, super simple. Forget everything else for a second. Part one is all about one thing, recognizing that, hey, you made a sale and someone now owes you money for it. That's it. And this is how it works, using that little bit of accounting magic called double entry. First, we debit our debtor's control account. Why? Because the money people owe you is an asset. It's something valuable the business owns, and your assets just went up. At the exact same time, we credit our sales account. Sales is an income, and when you make a sale, the value of the business for the owner, what we call owner's equity, increases. So what's the bottom line here? It's beautiful, really. Your assets are up because you're owed money, and your income is up because you made a sale. It's a total win-win on paper, even before a single dollar has landed in your bank account. But hold on a second, that was just part one of this story. You didn't just magically create money out of thin air, right? You sold an actual physical product. And now we have to account for the thing that just left your inventory. Exactly. Every sale has a cost. You paid for that item on yourself, and now it's gone. Your inventory, which has the official name trading stock, has just gone down. And you absolutely, positively have to record that. So here comes our second double entry for this one sale. We debit an account called cost of sales. This is an expense account representing what that item cost you. And since expenses are bad for profit, they decrease the owner's equity. Then, at the same time, we credit the trading stock account. Trading stock is an asset, remember, and since the product is now gone, the value of that asset has to decrease. And what this does is just perfectly mirror reality. Your expense, the cost of sales, goes up. And your asset, the trading stock, goes down. See? Your books stay perfectly in balance, showing not just the money you made, but also what it cost you to make it. Okay, deep breath. We've looked at the two parts separately. Now let's put it all together and see the complete picture of what happens in one single credit sale. And here it is, the whole shebang in 4 simple steps. One transaction hits 4 different accounts. Debtor's control and sales both go up. That's the good news part of the sale. Then cost of sales goes up and trading stock goes down. That's the cost part. This is the big aha moment. We record both the income and the cost right when the sale happens, not when we get the cash. It gives us a complete balanced snapshot. And hey, don't just take my word for it. This right here is the golden rule, straight from the source. It is an absolute non-negotiable in accounting. If you sell a good, you must account for what it costs you. The sale and the cost of that sale are 2 sides of the very same coin. So there you have it. The sale is officially in the books, the cost has been accounted for, and everything is perfectly balanced. But that leaves us with one big, obvious question, doesn't it? What happens when that debtor finally pays up and the cash actually hits your bank account? Well, that's a whole